Investing 10,000 in index funds versus individual stocks is a common decision many investors face. Each approach has its own advantages and risks, and the outcome can vary depending on market conditions, time horizon, and investment strategy. This comparison explores which option might have performed better over a given period. Index funds are designed to track a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. They offer broad diversification by holding a wide range of stocks within the index. This diversification helps reduce the risk associated with any single company underperforming. Index funds are also known for their low management fees, which can add up over time and impact overall returns. Individual stocks, on the other hand, involve selecting specific companies to invest in based on research, analysis, and market trends. This approach allows for more control and potential for higher returns if the chosen stocks perform well. However, it also comes with higher risk since the performance of the investment depends heavily on the success of those individual companies. A single poor-performing stock can significantly impact the overall portfolio. When comparing the two strategies, it's important to consider the time frame. For long-term investors, index funds often provide steady growth due to the consistent performance of the broader market. Over time, the compounding effect of regular returns can lead to substantial gains. Individual stocks may outperform in the short term if the right companies are selected, but they can also experience significant volatility and losses. Market conditions play a crucial role in determining which investment performs better. During periods of economic growth, both index funds and individual stocks may benefit. However, during downturns, index funds tend to be more resilient due to their diversified nature. Individual stocks may suffer more if the companies they represent are negatively affected by market changes. Another factor to consider is the level of involvement required. Index funds require minimal monitoring and are ideal for investors who prefer a hands-off approach. Individual stocks demand more active management, including research, analysis, and frequent adjustments to the portfolio. This can be time-consuming and may not be suitable for all investors. In terms of historical performance, index funds have generally outperformed individual stocks over the long term. This is largely due to the fact that most actively managed funds fail to consistently beat the market. The low fees and broad exposure of index funds contribute to this advantage. However, there are exceptions where skilled investors or those with deep knowledge of specific industries may achieve better results with individual stocks. These cases are less common and require a high level of expertise and discipline. Ultimately, the choice between investing in index funds or individual stocks depends on an investor's goals, risk tolerance, and willingness to manage their investments. Both options have the potential to generate returns, but the outcomes can vary widely based on market dynamics and personal strategy. Investors should carefully evaluate their options and consider consulting with a financial advisor to make informed decisions.